Good morning, Wall Street. Well, this is the first in a three-part series on a topic that's near and dear to my heart. And we're calling this series Judging Alpha. Now, what the heck is alpha? Looking for the alpha when looking at indicators and market data is kind of like trying to read the English into how the market is responding to a particular indicator setup or formation of patterns in the data. And this goes to the heart of technical analysis. I think that it's often expected of technical indicators to A, work all the time, and B, given a signal that you get an expected response all the time. And that's just not the case. First of all, you can't totally model a market. The market is a nonlinear environment. There are going to be things that are unexpected that can influence the price action of a stock or the market itself. So the idea is, how do you grade the health of a market? And the answer is by judging how it responds to various indicators and setups and triggers and all that kind of stuff. And that is what alpha basically does. It shows you the difference between the expected return and the actual return that you see in the market. Let's look at it another way. One of the things that you've heard me say a lot in the past is that when indicators fail to work, it can often be the best information you can get. Because when a market behaves contrary to what you might expect, given an indicator or a setup or what have you, that's telling you that something else is going on. It may be an exogenous influence, but nevertheless, it's one that's having an overriding influence on the market. And you need to know that when it happens. So what we're going to do in this series, we're going to look at three totally different kinds of technical indicators and see how we can pick out and pinpoint the alpha performance and how that helps us in judging the market. So in today's video, we're looking at a piece of data that is a representation of sentiment, and that's our put call and call put Erlanger option ratios. And basically what we're trying to do here, turn on the crosshairs, is we're trying to find excesses in pessimism when the put call ratio is high and when the call put ratio is low. So when you get to these points in time, you have an excess of fear and very little greed. Everybody wants to bet on the downside of the market here, and nobody wants to bet on the upside of the market. Now, such extremes in pessimism or lack of optimism are often associated with major market bottoms. But as you can see in this chart, there are several moments where you get these extremes in negative sentiment. In this first one here, you really only got the market to pause its decline. Back in 2008, this might have been construed as a setup for a major market reversal to the upside. But that's not what unfolded. So we have the setup, but looking at the action of the market in terms of following through, you worked off this fear, but you really didn't get much in the way of progress in the market. In fact, from here to here, the market highs are lower. And so that's a disappointing response to what looked like a very major indication of fear. And heading towards the latter part of the year, we have another major high in the put-call ratio and low in the call-put ratio. Another point of major fear as the market went to a lower low. So this peak in fear failed to keep the market from going to a lower low. And as that fear got worked off, the market paused, it bounced a bit, but it didn't go to a higher reaction high. And in fact, you have another point of excess fear here. And the response to that was a flat sideways move until the market sank to significantly lower lows. And you got another point of excess fear in March. Now, the response to that was a lot different than the prior ones. You had a nice, big, healthy, streamlined move up as the fear got worked off. And what's more important is that now you have more optimistic sentiment measures here, but the market keeps going. This is what I mean by alpha, how the market responds to the various patterns in this particular indicator is telling you how healthy the market is. So the moral here is don't be a robot and expect setups like this to immediately hand you a very profitable return in a contrary direction. That's why we look at sentiment indicators as a two-factor model. You need the setup in terms of sentiment, but you also need the trigger of price action to tell you that the market is actually indeed going in the opposite direction. And you only got that here. Moving along here, you can see that this is quite a low level of put activity relative to calls, and the call-put ratio is the highest we'd seen in years. That would make you think that this is a very vulnerable time for the market. But look what happened. The market did pull back a bit. We got to a moderately high level of fear by just this little teeny pullback here. That's extraordinary. Let's blow this up a bit. So we went to... So the market pulled back to basically the levels that it saw in April. And got us back to a high level of put activity, very low level of call activity, and the market took off again. That's very healthy. So now we're faced again with a similar level of sentiment, and we're going to see now how far the market needs to pull back to get us back to another point of fear. September being a seasonally weak month, this could very well be the most significant test for the market recovery this year. We're going to find out a lot about the health of this market, I think, over the next month and a half. In our next video, we're going to look at a market internal indicator and see how we can judge alpha by doing that. In our third and final video on this topic, we'll look at seasonality. Hope that helps. See you next time.